How's it going, everyone? Welcome to the Evafi podcast, where we bring express value add with financial intelligence. Today's guest, Raymond Wilson, CFO, Silver State Credit Union, 40 plus years in banking, finance. Pleasure to have you on.
Thank you, Justin. Appreciate it. Now retired, yours truly, and share with you my experiences, observations in my 40 years of banking. It's been a great ride.
And I love it. Also a big finance guy coming from the opposite side, being a broker. We work directly with the banks and everything like that. So have a lot of questions I'm interested to ask you today. But I want to start with, where you come from and how'd you get into banking?
Sure. Interestingly enough, I received my double major, finance and economics, Cleveland State University, so native Cleveland, Ohio. My master's in accounting, also from Cleveland State University. And I was actually in manufacturing, believe it or not, for about 5 years. And then I moved over into banking, an opportunity that presented itself to, one, get some SEC, Security Exchange Commission, financial reporting experience. Secondly, get some treasury management experience. And thirdly, get some leadership experience. So it was an opportunity in Cleveland to get started with my banking career. And then from there, it kind of mushroomed, different institutions, all from a controllership, VP of finance, treasurer, and then, of course, CFO for several banks.
What would you say is the most valuable lesson you learned in your time as being in banking?
Several things. The first thing is people development, staffing, training. The numbers speak for itself, but you can't get the numbers until you get the right people and get people trained, be able to educate, learn, and develop. I've always said, your employees are your largest asset on the balance sheet. And it's really the things of being able to provide the resources to enable them to be successful and provide the training and development, and then let them go. Let them do what they need to do to help the organization. You're only as good as folks that you work with and collaborate. And so I say that especially over the last 10, 15 years. If you would have asked me that same question 20 plus years ago, might have been a different response, maybe more number-centric. But you've got to have the right employees, but be able to treat with respect, being able to drive the culture and help with the education.
Man, yeah, you got to be able to invest in that human capital.
Make that investment.
Yeah, exactly. Patrick Bet-David, he said one time that really stuck with me. You have to treat your people right or someone else will.
That's correct.
100%. How do you feel, about modern banking and, where we're headed with, like fintech, crypto banking?
Mm-hmm. Well, I tell you, my friend, banking certainly has changed when I got started in the mid 80s. Yes, the banking that we know, you've got to embrace change, welcome change, and really partner with change. And I say that with fintech, short for financial technology. They are certainly carving and have been carving a nice niche within the banking sector, whether it be the mortgage lending, underwriting, also the cash payment systems. And so with those, you really have to work with, partner. They're not going away. And good. It's a good thing because it really, I like the competition. But it also, at the end of the day, it benefits the American consumer. In terms of the products that they're able to do, automation, efficiency, streamlined processes so that we all benefit. So, and we found that, certainly in the institutions that I've been with, partnering with the fintech and working with them, it's been a win-win.
Yeah, 100%. I've noticed from my side working with a lot of lenders, they have not put that capital investment into their technology infrastructure to be able to streamline a lot of those processes and be able to facilitate their originations, their transactions, and manage their portfolio. So as a broker, it leads to slow approval times or slow decision times. I deal with lenders where they'll be like, I'm going to send you a letter of intent today. And it's 4 days later. I'm like, hey, where is it? It's like, oh, sorry, someone had jury duty. So like, we're out. I'm like, well, like, shouldn't you have technology to be able, or another person to be able to fill in? So how many banks and financial institutions would you say are similar to how you guys partnered with the fintech are doing?
Sure. A very good question. To take a step back, 40 years ago, back in the mid 80s, we had about 18,000 banks here in the United States. A similar number of credit unions. Today, there is approximately 4,700 banks, and equally a number of credit unions. So we've seen a lot of consolidation in the industry. One of the reasons is being, especially for a financial institution that has a smaller asset size. Typically, banks, credit unions are tracked from one of the metrics based on asset size. If you're a smaller institution, you've got to be able to spend CapEx, capital expenditures, on technology. You've got to continue to reinvest, because what happens, and people have always asked, well, geez, Ray, what's your biggest worry? What keeps you up at night? That I wake up in the morning, Justin, and I'm irrelevant because you simply don't need me. You've got, you can go Rocket Mortgage, get a loan approved at 2 in the morning. You can look at, digital banking and be able to move money 24/7. If you're a smaller institution, lower asset size, and you have not made that capital investment for your customers, for your members, it's tough. It's just simply tough to be able to compete. It's a very competitive landscape, and you've got to find ways to be able to offer alternative products, services, excellent customer service. Otherwise, it's just, you're looking for an emerging partner. Certainly banking is regulated, but you've got to be able to provide those services and products to the customer because the customer demands it.
Yeah, 100%. Especially a lot of the younger generation,
Yes.
Millennial and Gen Z, they expect the bank to be able to have an app where I could, use Zelle, I could,
Yes.
connect digitally with Plaid, or I could, be able to automate a lot of different things. In business, on that side, what would you say for a financial institution is a fair ratio that they should invest out of 100% of gross revenue into that technology stack?
Sure. Very good question, Justin. I would argue 25%, because keep in mind, CapEx and technology continue to change, whether it's getting into a CRM, customer relationship management system, whether it's getting into a prospecting system, phone system, the being able to, and it's amazing what's out there in terms of the product, because to be able to compete effectively, if you're not able to do so, somebody else will. And that's where the fintechs come into play, because they're able to, primarily venture capital funded, not as heavily regulated from the banking side, so they're able to come up with a process, a system to be able to take those tasks that are the day-to-day and make more efficient, more streamlined, to be able to either offer that separately or partner with another financial institution. You look at Moneyline, you look at Chime, some of these fintech organizations that are younger demographic, using their cell phones. They love to boast the fact that they've never been into a branch. Ray, I don't need to go into a branch. I do everything. Yeah, I do everything through my cell phone. And again, it's bless them. They're able to do what they need. Again, it's finding what does the customer, what does the member want. and you got to be able to deliver.
Case by case basis,
Correct.
right? That personal scenario. No, 100%. I've seen both sides of it as well. Like I've grew up before a lot of the AI and automation came into commercial finance and finance as a whole, and it was relationship based.
Yes.
You know, you have to come in, you shake your guy's hand, your banker's hand, you know, have a relationship, which I still like to have
Yes.
that personally.
Agree.
But also I like to automate a lot of the processes as well.
Oh no, and AI, artificial intelligence. People always ask me, "Well, geez, am I going to lose my job?" No, embrace it, welcome it. Now your position will more or less morph into a things that you have been doing, but also a great opportunity for you to take on, things that you can now streamline and be more effective. So I welcome it. It's going to make your job easier. And so embrace change, welcome it. AI is here. It's not going away.
No, it's not. There was a portfolio manager that I've done a lot of deals with in the equipment space.
Okay.
And he told me a few years back when I showed him the technology I was working on with AI that I told you about what Eva does with the smart matching. He said, Justin, it took them almost 10 years. I was telling them 10 years ago to adopt e-contracts, e-sign, because it's more efficient than keeping these manila folders and file cabinets. How do you see the adoption happening if a lot of these banks and financial institutions are in the mindset as, I've done this way forever and it's always worked, and historically they've been reactionary instead of proactive when things come into play, the new factors, new risk factors, and obviously we're looking at a lot of different risk factors. You got AI, quantum computing, cryptocurrency, blockchain, stable coins. Now you have political and trade. So it's like, how do we manage all of these things financially and economically?
Sure. Again, very good question, Justin. You can't be reactionary because if you do, your business will move away. They're, again, a very competitive landscape. We all, as consumers, members, have options. And so you've got to be able to be proactive, be more strategic, to look at and understand your demographics, understand your market, understand your customer and membership base, to be able to, what are you, he or she, looking for? What brings you, Mr. and Mrs. Customer, member, to the branch, to the bank? Why are we, your PFI, primary financial institution? And so being proactive, being able to understand the KYC, know your customer. And so you have to be on top of things. You can't rest on your laurels. The market's changing, and it moves quickly. The dynamics, and what we see certainly in the media, and what we have a very knowledgeable consumer member base, and this is what they're looking for. This is what they need, and who can build a better mousetrap? And so you've got to be able to. And I talk about in your earlier question about the training, development, staffing. The being able to get an engaged workforce, being able to establish a positive culture. Those are critical because you always know that people leave managers, not companies, and so you got to be able to drive that and really continue to invest in your human capital. So
one of the things that troubles me a lot that I think about is quantum computing in the financial sector. When quantum computing becomes more readily available, do you think the financial institutions are preparing and using different mechanisms to be able to mitigate against those type of cyber threats that are coming up, in the future?
Especially your larger ones are investing in quantum computing. Your small institutions, looking at alternative ways to be able to, develop that. Again, significant capital dollars, and it's tough, especially as I mentioned earlier about some of your smaller asset-sized institutions, that to be able to compete effectively, they've got to be able to invest in those dollars. Cybersecurity, my gosh, it's a huge factor, when it comes to fraudulent activities, uh, be able to protect identities for our members, customers, employees, and again, spending the dollars, and it's tough. But it's and what we call the bad actors, the fraudsters, always finding a way to come up with clever ways to be able to steal your personal identity, being able to tap into your account and obtain funds illegally. So it just capital expenditure, being able to spend the dollars, to compete effectively. It's
You have to. You said that 20 to 25% put in that technology stack. I would say, from based on my experience, and I've dealt with probably maybe a different sector of, maybe similar sectors of lending institutions and banks and credit unions that you're familiar with.
yes.
I would say they put less than 5%, maybe if that. They maybe have a CRM. They pull your basic credit report, and then they have a human underwrite the file,
Correct.
right, and run the spreads and the ratios, put it in the spreadsheet on the matrix, right, and qualify it that way.
That won't work, my friend. In the old days, yes. The new days, it's you're always going to have your core, but will you grow? I don't think so. And your customer, your member, it's smart. He or she is smart, and they're able to, when it comes to the commercial lending group, you've got to, you just have to compete effectively and to be able to look at your metrics, your financial ratios, and compared to your peer group, and be able to generate a positive return, to your shareholders, to your members, and that. So it's exciting, but also it's a very challenging time.
No, I love it. You've been in banking so long. I'm interested to know your perspective on underwriting. I'd love to learn about masters in their craft. So I'd love
Yeah.
to learn how you underwrite a file.
Sure. Well, in the old days, you obviously did all the credit reporting, looking at all the particulars of the individual, the FICO scores, looking at businesses, the key ratios. Now with AI, you're able to take a lot more than just a credit score and really take. I mean, you still have that personal relationship, so I want to make sure you never forget that personal relationship. However, now you've got things and data to be able to substantiate your decision on whether you're going to approve or not approve a loan. And if it's not approved a loan, what steps you can provide your customer, your member, to be able to, here's what you need to do, here's what you need to consider to let's get this loan done. So yeah, with the quantum computing, the AI, it's just a lot more effective. The software, the analytics, it's love the analytics, and really it's again so much different, but good for all. You need to really again mitigate the risks, and really have that relationship, and really taking time and working with that relationship, on the lending side and the borrowing side.
What would you recommend to a small to mid-sized business owner to increase their credit worthiness to be able to get bank funding?
Numero uno, establish a solid, strong banking relationship. Get to know the folks. It's again still people to people, B2B, business to business, and so really helping. I look at a banking relationship just like you do with your attorney, with your CPA, with your insurance agent, with your financial advisor. Really establish that relationship, and really help him or her understand what you're trying to do, and so that he or she can really see, okay, this is what, depending on what you're looking to do, and the financing and the borrowing, that goes a long way to be able to have that, in place. Also, it helps to have a backup, a contingency plan to be able to work with another financial institution to be able to have that. You know, you don't want to put all your eggs in one basket. That said, being able to have a secondary source in that. So you want to have those relationships. It's critical.
And what's it like managing a balance sheet of a bank? I'm used to seeing balance sheets of businesses and income statements and taxes from that side. What does a tax return and a balance sheet look like for a bank?
Sure, very good question. Yeah, I love the balance sheet, as you know, income statement, statement of cash flow. Number one, cash is king.
That's right.
It's always been, and that's not going to stop. Um, Understand the assets when you look at for the balance sheet, the loans, inventory. You know, depending on whether it be a manufacturer, a retailer, wholesaler, how often does the inventory turn? Looking at your prepaid assets, really understanding the assets and liabilities, the borrowings on the balance sheet, because the balance sheet will tell you. It's amazing, you know, just looking at a set of numbers. Okay, I get it, but really understanding what's behind the curtain, what's behind supporting those numbers, the data, your accounts payable, you know, how current or how delayed are those payables, the expenses, you know, payroll. You want to look at, you know, are you meeting your payroll obligations, your tax liabilities, in a timely, accurate fashion. So you're looking at, you know, how that all translate, and then statement of cash flows. What's your burn rate? What are you spending on? What are you doing from an investment standpoint to be able to help grow? You know, versus being stagnant. You know, it's the competition is intense, and so you got to keep abreast of what's going on, being able to understand your market, being able to continue to develop your staff. So you've got a lot of things going. It's a lot of moving parts.
So how do deposits show up on the balance sheet for a bank?
Deposits show up as a liability. So, Justin, you make a deposit, open up a checking account. Obviously, for the bank, it's increase of cash, but it's also an increase of liability because that's a deposit. It's a liability on the bank side because at any given point in time, you know, those dollars are your dollars. You can withdraw, add to a forth. So those deposits then are used to make loans primarily, and if not making loans entirely, then looking to make investments, going to investment securities, whether it be for a bank size, U.S. Treasuries, U.S. government agencies, mortgage-backed securities, CMOs, collateralized mortgage obligation. So very conservative investments. Right. And then also you're looking for the expense side. So those dollars are used to certainly generate interest income on the loans and the investments to help offset the payment of the expenses.
And how much cash on hand does a bank or a credit union have to have compared to those deposits?
So right now in the state of Nevada, the minimum, what we call the primary liquidity ratio, is 5% of total deposits. I would recommend anywhere between 10, 15% plus to have, because deposits become seasonal. Summer months, you're going to see significant withdrawals. Why? Because your customers are utilizing those funds for vacations, seasonal activities. So you always want to have a good, steady amount of cash, strong liquidity.
Can you explain how a bank becomes over-leveraged or under-leveraged?
One, if it's over-leveraged, being able to have too much cash on the balance sheet and not doing anything with it, because now that's going to lower your net income, which then is going to, you're not, from a credit union standpoint, you're not serving your mission. You're not serving the purpose as a cooperative, a nonprofit by definition. And so being that or taking risks, you don't want to take risks, especially for a smaller institution. You have derivatives, hedging, an activity that certainly is more reserved for your much larger multinational or multi-state banks, regional banks, holding companies to be able to utilize. So you don't want to leverage it. Stick to your knitting, stick to what you do best. And like I said, you can't afford to get hurt because, especially for a smaller bank, one bad move can, especially from a interest rate risk standpoint. Let's say we're in a rising rate environment. All of a sudden, you do 30-year mortgages at 4%, 5%. Rates go up 6, 7, 8, 9%. Well, now you're going to get a squeeze. Why? Because you got a 4%, 5% mortgage. Rates are going up. You're not going to refinance. I'm stuck, having only earning this much of income when I could have, from an opportunity cost standpoint, have earned more. So now I got cash set aside, stuck in these short, lower interest rate mortgages for a long term. And that's quite frankly where we saw, certainly back in 08, 09, here in the United States, a liquidity crisis, where, banks were over leveraged on the balance sheet, high interest rates, and now deposit rates. If I'm paying, long-term CD rates, and I'm giving you a nice rate to attract new money, now I'm stuck. Mm-hmm. Because now, especially when rates start coming down, I'm still paying those high long-term rates.
Right.
Yeah.
Because you're locked in at a fixed.
Yes. It's interesting, as I've always said before, managing the balance sheet is managing, you're pulling levers, in terms of your loans, deposits, and the impact to capital. That's where banks can get in trouble where, you've got, a long-term balance sheet that has high deposit rates and long-term higher mortgage rates, but yet you're left holding the bag, so to speak, because your assets are generating a much lower rate of return, and yet I'm paying on the upside for that.
How do you feel about interest rates, where they're at now? Do you think the Fed's going to lower them? Any more basis by the end of the year? What does 26 look like?
Very good question. Well, as you know, the Fed's lowered rates 25 basis points here last month, late September. Right now, the Fed fund rate target is 4.25. Prime rate 7.25 right now. Based on what I read, and these things change too every time Chairman Jay Powell speaks. We all literally hang on every word that he speaks of, the minutes from those FOMC meetings. I'm expecting certainly one more, if not two more rate cuts, 25 basis points each by the end of this year, 2025. 2026, from what I'm reading, looking at maybe a couple more rate cuts. It's interesting because you look at 2022 and 2023, short-term rates went up 450 basis points. It went, and so, again, the Fed has a real challenge being able to manage those levers and being able to keep the economy growing, keep it moving without killing the economy. We saw the inflation rate a few years ago, 9%, about 2.5 years ago. Now inflation, I think the last numbers I saw for August, September, of course, is not released yet because of the current federal government shutdown, but the inflation rate's 2.9%.
Do you think that's a real number? I personally think I don't know if that's a real number.
Yeah, I don't know. I can walk outside and grab a sandwich, and all of a sudden that 2.9% doesn't seem like 2.9%.
When you got a $25 sandwich.
Yeah, exactly. Or even more shit when you get a gallon of gasoline. It doesn't. I don't. It's just a average.
What do you think inflation is really at?
Higher. If I would look at probably at least 5%. And really what's driving that too is when you look at the minimum hourly wage rate increases, whether it be statewide or at least the federal level. And so you're seeing that, which is then pushing up the price of the product and services that the retailer, the restaurant offers. And so that's where I see, inflation affects all of us. The 2.9% sounds, and of course from the Fed standpoint, they love to see 2%. That's their target inflation rate, 2%.
Obviously, what they're doing isn't working.
Yeah, exactly. Well, about 2.5 years ago was, if I recall, 9.3%. I want to say July of 2023, and it's come down. But to answer your question, I think there's more than that, just 2.9. You can almost ask the same question regarding unemployment.
Correct.
Yeah, right now.
Right, especially with the gig economy
Oh,
and
yes.
a lot of 1099s, unreported, and then, obviously a lot of illegal immigrants. Like there's a lot of factors that play
Yes.
into that statistic.
Yeah, I think the unemployment rate as of nationally as of August, 4.3%. But if you really look at the true unemployment rate, the underemployed, as you mentioned, we're much higher.
Yeah.
We're much higher. A lot of people, maybe have just dropped off and not even counted in that unemployment rate calculation.
What are some solutions to the unemployment issue?
The U.S. government needs to come up with funding, programs, job training to be able to get folks certainly that are capable and have the wherewithal to work, to be able to train, retrain, and provide jobs. My friend, it's all about jobs, being able to give them hope, being able to develop the training so that they can do what they need to do. So being able to give them a fair and productive wage so that they can live. They can be able to do things and provide food, housing to their families and loved ones. So you've really got to provide the hope through funding with the U.S. government, providing the programs and training. And continue to reinforce that. People want to work. I like to make that assumption. But they got to be able to, that incentive, they got to be able to provide, the government needs to provide training and have that money funded through the state to be able to provide that ability to find a job.
So I have a thesis.
Sure.
It's called The Great Displacement. And essentially, I am a firm believer in every business and every industry must install these 4 core pillars to survive over the next, roughly 5 to 10 years. Mm-hmm. The first is to have your own AI, LLM learning, large language model, learning from all your company operations, mm-hmm. financial transactions, et cetera, your brand online. Second is to have a brand online, a digital presence. So say you're a bank in your situation, imagine your bankers making content with their customers, like really showing like that engagement that mm-hmm. they have and posting content online, like how much more trust that would build back into the banking industry, into the financial industry, and how it would modernize it. Number 3 is obviously asset intelligence. More asset intelligence probably more than me by far, but I believe in diversifying off of fiat. So that's, getting into appreciating assets, real estate, gold, mm-hmm. some crypto, Bitcoin, depending on like lower risk, non as volatile ones. And 4th is to have quantum resistant technology. So mm-hmm. that's quantum proofing all of your technology stack, all of your infrastructure, because in your use case as a financial institution, one leak could be 1,000 people's social security numbers, credit right. reports, financials, and then a bunch of loans get taken out on behalf of that business. So do you think those 4 core pillars would work with any modern banking and financial institution?
Yes. And thank you for the reminder on those 4 pillars, because I certainly believe in those. For a financial institution to survive, it needs to certainly comply with and really strengthen their relationship with those 4 pillars, because that's where it's going. Banking is where it's going. The strong will survive and continue to move on. The weak will not survive and or be picked up, gobbled up by another institution. That's just uh, our economy is such that it's, and our members and customers require that. And so those are the things that, you mentioned Bitcoin. Right now, until the Federal Reserve Bank, between Bitcoin, cannabis, still restricted for banks to hold those as assets on the balance sheet. Eventually, there will be some solution, and hopefully where
Is there any banks that could hold cannabis on their balance sheet, or do you have to have like a special? Is there a specialty license that comes with
well,
it?
banks, I know of banks that have some maybe as a separate subsidiary. The challenge is,
They keep it as a separate
yeah,
subsidiary.
it's certainly from a security standpoint, from a compliance, regulatory, it's again restricted. I see some relaxation on that in time. When you look at cannabis, still considered a type 1 controlled substance.
Right. And government has to change that
Yeah,
federal
exactly.
classification.
My friend, there's too much money on the table.
It's too much.
Yeah, and it will because
And, I mean, if you just make the one-to-one comparison of alcohol versus marijuana, I would say marijuana is far less risky. Far less people die, far less people get in car accidents, far less
yes,
people drive under the
true.
influence. Like, there's just far less consequences that come from marijuana. So I feel like, okay, we should have pretty similar laws comparing those two, if it's like comparing an apple to an orange. Why do you think the government hasn't yet fully changed the classification on marijuana?
You've got, oh geez, boy, we can get into a long discussion politically. It's going to happen. When you look at cannabis, because as I mentioned earlier, too much money on the table. Credit unions, because by definition they're nonprofit. So by doing so, could compromise its tax exempt status with the IRS. So you certainly,
For banking a company that offers a controlled substance.
yes. And so it's going to occur. It's just a matter of, can the U.S. government get its share of, yeah. And that's where I see, I think it comes down to a financial situation where, but it's going to, because again, as consumers, as members of banks and credit unions respectively, it's, we're gonna want this. And so, and if I can't get it, I'll find somewhere to be able to, I mean, when you look at the dispensaries here in Nevada, it's tough. It's tough, because
And they have a profitable business model.
Yes.
It's a good business model
Correct.
that generates cash flow. We talked about cash flow. Cash flow's king, right?
Yes, right.
They're generating physical cash.
Yes, yes. But think about the security, the reporting. It's just a tough thing. But I see both Bitcoin and cannabis eventually becoming mainstream. So I don't know if that's going to be the next 5 years, 10 years, but it will occur.
How do you feel about AI identity fraud? I know we talked about a little bit with Know Your Customer. I think it's very important that all financial institutions on any financial transaction over a certain size should KYC every time. It's just too risky not. It's too easy to, right now, I don't know if you see all these AI videos online, but it's pretty easy to impersonate another person. So do you think it should be required that on financial transactions, they should all KYC?
The short answer is yes. And the reason, I love AI. The risk, though, is that your bad actors can get that and rewire that as such to be able to work against us. In terms of being able to, whether you get a phone call, Justin, that shows your bank's call number, you pick it up. You get a call from a representative of your bank that says, just want to call to see, confirm that you just made a large purchase at Costco, for example. And you say, Costco, no. It shows that you purchased a brand new TV for $799. No, and then, of course, you got your wife in the back. Hey, honey, we got to get to our gala. We're running late. Yeah, Well, tell you what, Justin, I can get that corrected. Just need your account number and or PIN number and or social security number. And in a haste, you're saying, okay, well, it's my
Yeah.
information is this.
So they
Okay.
spoof the number. That's
They-
literally happened to me
Yes.
before.
And so you're relieved. You hang up the phone. Your wife asks you, oh, honey, who was that? Oh, our bank called. They said, I made a purchase at Costco. Really? No, we don't even have a membership card there at Costco. And so you're driving down the street, and then you realize your wife asked, did you give them your social security number? Yeah. And then all of a sudden you realize, oh, no. And then all of a sudden you've got, your cell phone's got alerts showing withdrawals from your checking account. It's and that's where and so AI, while it's going to improve and enhance, certainly and mitigate risk. To the contrary, if it gets into a very clever bad actor, they can then make it even more tougher. So that's the tough part. And so you've got to be able to have the system. We have OFAC, Office of Foreign Asset Control. So when we make a wire, we always run that through OFAC to ensure that the recipient's not part of a terrorist group. That's not part of a no wire list. And so you just it's there. There's just too many things like that happening that are affecting, and they know that, and of course, elder care. There's situations where elder care abuse, where they are targeted for scams, and it's amazing. It breaks your
Getting
heart.
sophisticated.
Yeah, it breaks your heart when you see a customer, a member that lose their life savings or a significant amount of savings that they thought they were doing the right thing, and so
Yeah. I mean, it's only going to get worse with the technology on that we have in its infant stages. And I think, what can we do to kind of like raise red flags to financial institutions to be able to, install better technology to be able to prevent against, things like the spoofing, as we talked about, identity fraud, once quantum computers are more readily available. What are some solutions?
well, we've done, and certainly in the past, education. Certainly on our website, also social media. We will never ask for your social security number. We will never ask for your account number. And that's true. We won't. Don't need to.
You already have it.
Bingo. Thank you. Education, and not only with our members, bank customers, but our employees. Because it's tough, when you're a bank teller, when you're a credit union, MSR, member service representative, boy, and I give those folks a lot of credit because they're the first line. When you come in, a customer comes in, and the check can be altered. It could be a counterfeit check, and I'm telling you, even as a CFO, when I've seen examples, it's tough. I mean, you look at first glance, looks like a real check.
Right.
Looks like a legitimate check. Could be a U.S. Treasury tax refund check from the IRS. You look at it, and it's like, okay. And so really being able to scan it, being able to look at it. So it's really education, training our employees, our members, providing classwork, seminars, and continue to do that. It's not going to go away. And so it's just education, and you do the best you can in providing those resources, for your customers, members, and employees.
What's the recourse there when, let's say, one of the tellers cashes a fraudulent check, like the bank takes that hit?
Yes, the bank. If it's proven that it's not, where the member tried illegally or purported himself to be somebody they weren't. But the member, at the end of the day, in most cases, generally speaking, the customer, the member, is made whole. It's a huge line item on the expense side of the income statement for a bank and a credit union.
How much is it in terms of percentage like that you have to write off due to fraud?
Yeah, well, that's when you look at it could be when you look at your total operating expenses, it could be anywhere from 1% to 5%. Now, fortunately, you do have your fidelity bond policy, so you have insurance that will cover. You'll be on the hook as an institution for your deductible, and the insurance company will cover the balance. But that can only go so far and go so long before you lose your insurance. And so now you got to find, no different from if you file a lot of claims on your homeowners, if you file a lot of claims on your auto, all of a sudden you can be dropped. And so it's, like I said, it's a big thing. But generally speaking, at the end of the day, your bank customer, your credit union member will be made whole, because that's, unless there was some deliberate fraudulent where it was really trying to basically embezzle funds in that.
Which, of course, there's a lot of those bad actors out
Oh,
there.
yes. Yes.
I'm very interested to hear about the SWIFT system and how you feel about different cryptos and ledgers that could fulfill the same functions, such as like an XRP, an XLM, the different ISO 27001, I think, certified. Don't quote me on that.
Sure.
How do you feel about a switch from the legacy SWIFT system to a faster settlement system?
I'm for that. As long as your organization, certainly from a training and development, again, I think a lot of these things tend to be more reserved for a much larger institution. However, I think from a training, development, and really understanding, having that same day settlement is critical. And again, as a member, customer, if you can't provide me that, then I look at going elsewhere. And so I think, that technology, and that's where you really have to welcome change as bankers. We have to adhere to that because that's what our customers want. And so I like that. I think that, again, all in the benefit for, your customers and members. So I think certainly, the Bitcoin, the XRP, I think those are the things that will, you've got to be able to look at that and really look at the impact. And so what are we going to do from a cost standpoint, from a capital CapEx, as well as from a training, being able to provide that, And that's why, again, your smaller institutions, asset size, it's going to be tough. It's going to be tough because it just, from the funding, the cost standpoint, can they generate the dollars to be able to afford this?
How do you think banks could compete by offering diversified products and accounts to match, some offerings that some of these fintechs and crypto financial institutions are offering that, appreciate, higher than we say inflation's at least at 5. So how do you offer an account that's at least over 5 so the customer, the depositor, isn't just bleeding?
I look at, in my prior life, we partnered with several fintechs. Again, who can build a better mousetrap? Who can build a better model? Fintechs, they have it down, and they have the dollars. That's why they were able to make that investment. Versus, do we as an institution organically spend the money to be able to drive that? You do have to diversify because, again, customers and members expect that. They want that. But you got to be able to have the cash to do so. It's like anything else. Do we partner with a fintech that's their specialty, or what's it going to cost us to grow that organically? And I've seen it done both ways, depending on what is going to be done and how it will be achieved. Fintechs, again, I like fintechs. I think they bring, they're, at the end of the day, it's all about the customer, the member experience, and that's what we're in business for. Our customers, our members are our lifeline. Without them, we have no business.
Very true.
Yeah.
So you said you're pivoting a little bit in your career now, shifting to little bit of investing, I hear.
Yes.
You told me you've always been a banker who's an entrepreneur mindset, which is actually a very interesting dichotomy.
Yes. Interesting. Yes. Yes. I've been fortunate. In the sense that Justin, I've had several good mentors in my career, and I've been part of the executive team, the C level, where we have been involved in acquiring a bank, selling a bank, starting a bank. And so, I like that deal making. Again, how we can certainly, achieve economies of scale. At a personal level, now as I get into my next chapter, looking at doing some M&A, merger and acquisition work, PE private equity, VC venture capital, obviously at a much, much, much smaller dollar threshold. But, what I see here in Las Vegas, there are deals being done. There's a lot of activity. I see certainly kind of a junior version of Silicon Valley, and it's only going to continue to grow. I think certainly the business climate is favorable here in Nevada. No state income tax, it's huge. So that really beckons a call for folks to start a business. There's a lot of organizations, that support that, venture capital funds. So, yeah, I just want to get involved and lend myself as an investor. And there's a lot of neat things that and folks that I've spoken with that are being proposed. It's just, a lot of it's just taking everyday tasks and making it much more simpler, much more streamlined, much more efficient, much more convenient.
What does that process look like, buying and then selling a bank? What encompasses that?
Well, if it's a publicly traded bank, it's looking and doing your due diligence, being part of the team, a task force to evaluate the financials, also evaluate how does I've always believed in 1 + 1 = 3. Well, I learned it was 1 + 1 = 2. 1 + 1 = 3 because the sum of the parts is greater than the whole. And that's one thing I've learned. And so it's got to make sense, this is where you get the shareholders, obviously, but also the board of directors from both institutions. Sometimes it can get dicey, in terms of who's the acquirer and who's the acquiree, and who's going to survive from not only from the board positions, but also your executive team and employees. You don't need two CEOs. You don't need two CFOs. You don't need two branches that are next to each other. Yeah. So you.
Bunch of fat.
Yes. So, but you've got to achieve scale. I mean, you're going to do that to achieve scalability, and you want those at the end of the day to be accretive to income. Again, your shareholder as a bank, your shareholders are your owners, and so that they're expecting a desired rate of return, and so that's what you do, and you want to see, does it make sense? What can the other institution provide in terms of ancillary products, complementary products? Where are they strong? Whereas in your offerings, you may not be as strong, you may be deficient, maybe somewhat weak. And so you can combine institutions. So you're going to see that. You haven't seen too much of that due to regulations. Again, banking is, as you know, very heavily regulated. And rightfully so. Why? Because, the banks and credit unions, it's a safe haven for your deposits, for your loans. So we don't want to mess with your money. We want to make sure that you've put the trust in us by making a deposit. You want to know that your money is safe, sound, solid, and that you can at any given point in time withdraw money, deposit money, and for that earn a reasonable rate of interest. And so as well as loans. So you want to you look at, you don't want to have what we had a couple of years ago, a Silicon Valley Bank, where there was a run on the bank. All of a sudden, Silicon Valley Bank was forced to sell assets at an unrealized loss. And so those are things that all of a sudden they puts that too big to fail doctrine. Maybe not so much. But yeah, you got if you mind your business and being able to provide what your customers, what your members want, and being able to invest accordingly, both on the balance sheet with your employees, you'll do well.
So if you had to give 3 suggestions to that small to regional sized bank or credit union to make it over the next few years with all the different risk factors, what would
Sure.
you say those 3 things are?
Sure. Number one, invest in your employees. Your employees, without your employees, you have nothing. Being able to train, develop, and continue training, recruitment, attracting employees, and especially retention of employees, retain those. Secondly, being able to be the best that you can be, being able to offer those products and services that are either second to none or what's your story? Having a compelling story to tell, being able to provide, why should I, as a consumer, as a member, open up an account? Give those reasons. Have a story to tell, as to why you should join us, why you should open up an account. And thirdly, and this is huge, I wanted to mention this earlier, something that I take a lot of pride in, and I think there's always work to be done with organizations, community give back. Folks, you've got to be involved in your community. You've got to be willing to spend the dollars to support the community that you live and work in and operate in, because that's what our customers, our members demand. They want to know, you being a good corporate citizen, to be able to, yeah, I get this. I understand that what you're doing. I want to be a part of that team. I want to be able to invest accordingly. So community give back, is extremely important. It really, I think, helps separate yourself from the others. And to me, it's required. It's needy. It's needed for what to be able to stay in business, because there's too many reasons, certainly for somebody to join your institution, just like there's a lot of reasons to leave. And you know what? I've got you as a customer, bank, credit union member. What can I do to help you?
100%. And last thing I want to talk about and hear your perspective on CBDCs, central bank digital currency. How do you feel?
I like it. I think that, again, the education, I think, getting institutions to be able to bring that on board, it's happening. You look at crypto, you look at Solana, you look at Ethereum, you look at a lot of these. Whether you want to or not, your customers and members are going to expect it.
Correct.
And you can't, if you can't compete, then you just won't compete and you won't grow. And so it's the way of life. It's the way things are going. And it's just like, it's no different from any other industry. You've got to be able to compete effectively, being able to provide the products and services that your customers and members want. It's you can't rest on your laurels. Can't be complacent. Can't be same old, same old. Can't be status quo. You gotta be relevant, my friend.
I love it. Raymond, thank you for taking the time out of your semi-retirement.
Thank you. No, I love it. I appreciate it. Thank you for the invite. Thank you for the consideration. Thank you for having me here. I love it.
I had a lot of fun.
Yes, I did. Likewise.
We gotta do this again sometime.